we're happy to have with us again today Daniel Carney, financial advisor from Good Life Financial Advice. Today's topics, we really want to pick Daniel's brains on new builds versus community housing. Now, there's an acronym for it, community social housing providers, but there's an acronym for this.
Yeah, just remember California Highway Patrol.
Ah,
no, not really.
CHIP.
CHIPS.
Okay, community.
So community housing provider, they're calling themselves CHIPS, I believe. It's early days, but I think that acronym's stuck.
Yeah, it's okay. It's got a ring to it. So if we're talking about CHIPS, folks, that's not what you're going to get in the local sort of neighbourhood establishment. Nor is it sort of in a 70s TV series. So the deal is, right, that if you are renting your house out to a CHIP, to a community housing provider, that you can claim 100% deductible, or deduct 100% of your interest. In other words, it's kind of things as they were. However, it's not all necessarily great, let's rent our property out to a social housing provider. And I know just in talking to our clients, there have sort of been some real world comments about what that's like. So from your perspective, Daniel, as a financial advisor and talking to your clients, we'd be interested to know what are the pros and cons of going the whole new build route, borrowing versus trying to buy an existing house, I guess not being able to get any back my build or anything like that, and rent it to a social housing provider. What's your take on it?
Yeah, well, I guess as I was saying before, a little bit of a disclaimer as it's a little bit early days in this space, but I do see it as a huge opportunity, actually, and you could probably call it a bit of a loophole in that it is a way to continue to be able to have that tax deductibility of the interest, even though it's an existing residential investment property. We have got clients that have gone into that space, and I must say we haven't had any negative feedback about the tenants and the leases at this point. It is early days. On that subject, though, these companies, they're private companies. Some of them are charities. For example, the Salvation Army, as an example. We've got a client who leases to them. They do have very strict leases in place in terms of how well they look after the properties and the maintenance. There's zero property management. There's zero vacancy rates. Not only that, but obviously you're able to continue to count the interest as a tax deductible cost. So it is a great way as an alternative to new builds, and you can see why the government's trying to not only encourage new builds, so they don't want to poo-poo the benefits around that, so they're allowing investors to get away with a bit more. They're also doing that with social housing, and it's not just Kaingaora that they're rolling that out to. It's these privatized companies that are doing the same thing. Transitional housing, social housing, etc. So it's if you're not able to get into that space, or you already own one and you present it to one of these linked people or one of these other companies that are doing it, there's a number of them, you might be able to continue to have that tax deduction. So it's a great thing. Yeah.
What we'll do is we'll post a link either in the video here or in the blurb below. There is a Community Housing Regulatory Authority, and so there's 62 registered community housing providers at the moment. Interesting fun fact, they have nearly 15,000 properties under management. So that's how you can check, are they a legit CHIP or not, and thus would qualify for this. What I'm thinking though, and look, I want to talk about this versus new builds, get your thoughts, but I must admit that some of our clients do rent to them, and that's been like, great, you can keep on deducting your interest. However, I've also had the comments about one particular provider who they've been very hard to deal with. I guess there's different experiences, aren't there? Some are probably like, they're fantastic, and others are like, this is hard work.
Yeah, I was going to say that before, actually. my opinion of that is that's why it's great that I think anyway. And again, look, the proof is going to be in the pudding. But I think it's great that these very well-run professional private companies are coming in and taking over where the government was previously the only ones doing that kind of role, or predominantly doing that role. So I think it's a good thing. And I've had some really good conversations with some very good professional people within these organisations, and they've all they've said they're inundated with landlords coming to them. So they're busy. But I would like to think, and I would like to hope that you would probably get a better service. I'm not trying to poo-poo the local government or the government departments here, but you're probably going to get a better service from a private company than you are the government. So again, it's going to be proof is in the pudding, but that would be my take.
I guess the next step down, like you're saying, a commercial chip, it's a different mindset, it's a different mentality. So in terms of a less stress approach, the reality is it may be better if you want to do that, deal with one of them rather than trying to go to the government department directly. Yeah,
and the guys I've talked to, I feel like their hearts are in the right place. They've said we're not, if you've got a, and this is, this might be a little bit of a letdown for some. If you've got a property and you're thinking you can just boot your tenants out and get one of these leases going, they're not interested in kicking tenants out just to replace them with these community housing people. They do want a truly vacant property to be offered up to them. So whilst we could say they're about the almighty dollar, the ones I've spoken to have got their hearts in the right place about the welfare of existing tenants as well as potential tenants through them.
Well, that's good to hear. Right, it gives a little bit of restores a little bit of faith in humanity. Yeah. Now, while that's good, it would seem, and obviously this is not our specialty, but it would seem that you're going to be subject to the same. You require a 40% deposit if you're going to buy an existing house because it's investor lending, and it doesn't matter that it's a social housing provider. We've just seen BNZ come out this morning and say they're going to put, they're only going to lend 6 times your income, so limits like that, etc., etc. That's going to be interesting to see where the other banks follow that lead or not. Whereas with new builds, our understanding is actually that it's quite a different ball game in terms of getting lending. Can you sort of tell us about that?
Yeah, so that's a good point. You need to make sure you've siloed out those two things whilst the bank, the government's still, exempting those properties in terms of the tax changes and the deductibility of the interest. It doesn't change the LVR rules. You still have to have a 40% deposit, as you said. If you've got that in the equity of your home, that's fine. It doesn't have to be a cash deposit, but yes, you have to have a 60% LVR, as it's known, or 40% deposit. But with new builds, there is no LVR restriction. There's no deposit requirement restriction that's forced on the mainstream lenders by the government. They don't really call themselves the government, do they? Pseudo-government, the Reserve Bank. So it's up to really the banks to decide what deposit requirements they're going to have as their own lending criteria. And you can get away with as low as a 10% deposit at the moment with one of the mainstream banks. I guess I can say it's ASB and Sovereign Home Loans. They'll let you go up to 90% lending. They have stricter criteria around it in terms of the serviceability of that debt, etc. But you only have to have a 10% deposit with them, and the interest rates are very low, as you were talking about before. They're in that sort of promotional space, so below the standard interest rates that mortgages are at the moment, and that's even regardless if it's a 90% loan. So these are really unique times and unique products that are out there at the moment for new builds, and existing properties if we're talking about renting to these chips. So it is a very unique space at the moment, and I guess this is why it just blows my mind how up in arms people get in the papers and things about how difficult it is, when really there are options out there, and you just need to get advice from the right people, and there are opportunities. Yeah.
So these rates at the moment, they're significantly lower. I mean, previously we'd heard sort of like between 1.7 and 1.8, those sort of rates.
Yep.
But previously, are those rates that we had previously, so that 1.7-ish space, are they still available, or is this a being quick because we don't know how long that's going to last?
No, they're going to be around for quite some time. I believe ANZ have said they'll carry their promotion through to 2023. So if you start the process anytime between now and 2023, you'll get a couple of years of that with ANZ. The ASB group, which is ASB and Sovereign Home Loans, I've been told today that that's going through to 2025.
Wow.
So you start that process between now and 2025, you get 3 years of that promotional rate. Just as an update though, because they are a floating rate. So you mentioned they were 1.68 and 1.79. Because the OCR has gone up 25 basis points, or 0.25%, those rates have gone up 0.25%. And they'll do that. They'll just match the OCR movements. They are a floating rate. So, it's now gone up by 0.25, which is still way below the market rates. But you are at the mercy, which isn't necessarily a bad thing, but you're at the mercy of the OCR movements with those promotional low rates. But whatever they become, you're still going to be well below the market rates for that promotional period of time.
Okay, all right. So now one thing, just while we're on this subject, is chatting to some clients recently, they said, we had looked at ANZ, but their rules were quite strict around, and the properties had to be, was it Sigma 6 or something, I can't remember what the terminology was, compared to the ASB rules were a little bit looser for the new build. Have you seen anything like that in I guess in the wild, as it were, and sometimes there's arguments for staying with your existing lender, etc., or are the requirements sort of pretty much more or less the same?
Yeah, I'd have to say that's the first. I haven't heard that. It was a blanket statement I had today is, as long as it's a new build, you're going to get that back my build rate for the next 4 years. It's there. I haven't heard any requirements around standard. The building code would surely be good enough. I know that there was some talk of some level of healthy homes certification through the ASB group, but it's so expensive to get that certification that's actually not even worth the cash contribution that you get back. And I don't know if I should be saying that, but we just decided to put it to bed because it wasn't even worth the time and effort. So apart from that, no, those, from what I've seen, a standard new build property will qualify.
Okay, great. Right. So in other words, I guess the old adage that the sooner that something is, what's Confucius say, the best time to plant a tree was 20 years ago, and the second best time to plant it is today. So the sooner that someone can get onto this, the better. And but that being said, it seems that the stimulus and ANZ and ASB leading the way with these sort of special rates is going to be with us for a little while. One thing that I do hear from people is like, that these new builds, how do you get one? They go so fast. How do they do that? Is it just, look, the easy way is for busy people, talk to a financial advisor like yourselves, because you already got the connections, etc. But if you're competing with everybody else, it's a bit like going to an auction, because otherwise you're just getting snapped up within sort of 20 minutes, that type thing. Would that be a fair comment? That's sort of what we generally imagine to be the case, but have we understood that correctly?
Yeah, you're bang on correct. I think we kind of touched on this last time we did a video together. I would not be wanting to do this on my own out there. I just shudder to think how difficult it is out there. And just as a prime example, today I had a young couple. This is not normally what we get involved with, but we just happened to have an opportunity that fit their situation. But they were a young couple who were buying their first home just outside of Christchurch. I had a phone call from a mortgage group that we know very well. One of the guys from Mortgage Lab got in touch and said, "Oh, you wouldn't know of anything that," and just so happened we actually had something. And but their story was that they had their hands on something. I don't know who the builder was. The builder came back and said, "Oh, sorry, we put our price up by $100,000," and they said, "Us, we're out of here. That's it. We're just going to sit tight till the new year." And so when I spoke to the mortgage broker about it, I said, "Oh, look, I'll see if there's this opportunity." It was there. My opinion was, look, guys, don't sit tight for till the new year. You're gonna effectively probably miss out on, I don't know, $50,000 to $100,000 in that time because it's going up so quickly down there. So that's just one story of the mayhem that's going on out there. And thankfully for us, and they've had to have been very well nurtured, I have to say, we have long-standing relationships with a number of builders around the country. I'm not going to say that we've got a tap that we can turn on and properties pour out of it by any means. It really is a daily job for me to be, sitting on these guys to give me opportunities for our clients. But thankfully, we are able to fill the demand. I do not know how people out there are doing it. I don't know. Yeah. I just shudder to think.
Yeah. So there are sadly unscrupulous individuals, out there, and recently, in fact, we'd heard of something which also the person trying to do it on their own got alarm bells, issues not disclosed, and thought, okay, we don't want to be involved in this. So fair enough. So, all right, well, we really appreciate those insights here. Thank you very much, Daniel. And folks, stay tuned because our next video interview with Daniel is going to be about a highly controversial subject for some, and that is cryptocurrency. And we're going to talk a little bit about the tax treatment of it. Daniel's going to cover the investment side of it. It's gone from being like a rah-rah to a pariah to, actually, so there have been a lot of interesting developments. That in itself is quite a big subject, so we're going to dedicate a separate interview to that. So look out on the channel soon for an in-depth consideration of this subject, what you need to know about crypto as part of your investment portfolio. Well, thank you very, very much for your time today. As always, Daniel, really appreciate those insights and thoughts. And of course, the details for Good Life Financial Advice will be linked, posted, something like that here, so you can get in touch with Daniel and have a chat about your situation.
Thank you, Gareth. I really appreciate it.